You're live. Hey, everybody. Welcome to the Metastock webinar tonight. Hope you're doing well. Thanks for coming. Let's go ahead and get straight to the legal disclaimer. I know it's your favorite part. Today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. So I'm glad I hope you like that. Today we do have a special guest, Tom Wood. Tom is going to talk to us about a very popular add-on that we brought on just a few months ago, really. Has a patented methodology that does looks at value. It's actually really been a well-received add-on. So let's go ahead and bring Tom on here. Tom, can you hear me?
Yeah, Jeff, I'm good to go.
All right, I'm sending you the screen presentation. I'll let you know when I can see it. I can hear you.
Let me get this up and going here.
Perfect.
There we go.
Looks great. Sounds great.
Good deal.
And it's all yours.
All righty, thank you. First off, thanks Metastock and thanks Jeff for having us on again. Really appreciate it. Always a pleasure to come and speak with y'all. For those of you not familiar with who I am, my name is Thomas Wood. I'm a partner at Basecamp Trading, also the director of trading operations. And today we're going to be discussing trading with value and momentum. Before we get into the good stuff, though, I always go over risk disclaimer as well. I know Jeff went over one also, but just got to make sure we do it. Just keep in mind, trading or investing carries a high level of risk. Whenever you're trading, you only want to be trading with risk capital. Okay, there's always a potential to lose money when you're trading. So I always recommend that people look, trade with risk capital, and there's a twofold reason behind that. First off, if you do lose money, it's no big deal. Okay, and when I say risk capital, I mean money you do not have set aside for something else. So you don't want to be going and taking your kid's college fund, for example, and trading away your kid's college fund. The second reason that we say this is emotions get involved when it's money that you cannot afford to lose, because you're sitting there going, I can't mess this up. I got to make this work. I can't make a mistake. And it puts a huge burden on your shoulders and a lot of pressure on you as a trader to stick to your rules and follow a plan because you're emotionally involved with that money. Then along those same lines, we're required to show you CFTC Rule 4.41, just hypothetical disclaimer saying, look, past performance is not necessarily indicative of future results. That being said, the tools and strategies I'll be talking to you about today are patented. We've done tons of back testing and forward testing. We've used them for years and years and years. But with that being said, I can't show you examples from the future. I wish I could, but I can't. So there's no guarantee that what happened in the past is going to happen again in the future. All righty. So with that being said, let me introduce myself a little bit better, tell you a little bit more about my background. This is me, Thomas Wood, and my beautiful wife, Dora. And there's two big things that always come up whenever I meet somebody or introduce myself. And the first one is, wow, Thomas, you're really young. And I always say, yeah, I'm pretty young, but I've been trading since I was about 13 or 14 years old and have already spent more time trading real money than most people will in a lifetime. The only thing I've ever done in my professional career is trade for myself, trade for others, run a hedge fund, be a partner in a hedge fund, and trade for a hedge fund. Now I do trading education and have a prop shop on the side. With that being said, the second question that always comes up is, well, if you're so good at trading and you make trading so easily, then why are you teaching people? Why aren't you just sitting in your office and trading for yourself every day and doing whatever you want? Well, in order for you to understand why I like the education and like the technology space like this, you got to know why I got started in the industry in the first place. So the whole reason I started trading, growing up, my dad told me, he said, look, Thomas, you don't want to be doing this backbreaking work that I'm doing, which he owned a construction company. There's nothing wrong with that. But he said, you don't want to be doing this backbreaking work that I'm doing when you're older. You want to have the freedom to do the things you want to do and the time to spend with your family that you want to spend with your family. And the best way to learn how to do that is by trading. Well, he went out there and started looking for quote unquote gurus to teach him how to trade and ended up losing hundreds of thousands of dollars. And I thought, you know what? That's not right. And I wanted to become the exception to the rule and actually show real regular people that, look, anybody can learn how to do this. And I wanted to really help people like my father learn how to trade. Now, that being said, I've worked with thousands of traders now around the world. I've also worked with multi-billion-dollar funds doing consulting as well. So moving on from there, let me tell you a little bit more about us at Basecamp and who we are. For those of you not familiar with us, the partners here combined, we have over 40 years experience in hedge funds and professional money management. We're a trading technology and education company. We have patented trading tools that's been featured in Bloomberg, CNN Money, Barron's Money Show, Traders Expo. I've done consulting with multi-billion-dollar funds as well as thousands of retail traders around the world. And we've been speakers around the world at various events and things. Now, one of my proudest things I can say that I've done is I've helped somebody go from a retail trader that was consistently losing money to literally running their own hedge fund, and they run a bond fund. So our goal, though, is to help traders become more profitable. And with that being said, we practice what we preach. This is a broker statement from one of our funds in the past, showing $4.8 million in gains on a single month and up 7.6 million on the year. Okay. So with that being said, one thing I always like to cover, everybody's heard that statistic that 90% of traders lose money, and 90% of people out there are going to lose money when they go trade the markets. And that's probably true. But there's three big things that really separate consistently profitable or professional traders from those that end up coming into the industry and then all of a sudden losing everything and looking back and they made no progress. So let me tell you what those are. First off, number one thing is maximizing profits. Now, I do not mean getting at the exact top and getting out at the exact bottom of every move. Nobody can or does do that. Now, with that being said, most traders, I found that most retail traders leave money on the table. Okay. They don't maximize their potential returns. So you look back at the trades they've taken and you say, okay, well, if they had just sat on their hands for the next 3 or 4 hours, they would have been fine and would have made 10 times the amount of money. But instead, they got out with $100 profit instead of $1,000 profit because they got too impatient or they got too scared. And their emotions kicked in and they didn't want to give back those gains, those small gains that they had. So instead of making big gains, they settled for a small gain. Right. And that makes it harder to stay consistently profitable. The next thing is confidence and approach. Now, this is something I see happen all the time, especially when I do consulting with people and I go in and we start looking at their trades and they say, yeah, I saw this right here and I thought it was good, but then I got afraid and I didn't click the button when I was supposed to. I didn't pull the trigger when I was supposed to and actually jump in. And they end up missing the trade. Then the market moves just like they thought it would and it runs their direction. So now they're late to the trade and they try to jump in late only to now have missed the boat. And now they're getting in late to the move as opposed to the start of the move. And they end up losing money because they're getting in the tail end instead of the beginning. And that stems from a lack of confidence in their strategy. All right. So one of the other big things that separates consistently profitable traders from those that are losing money is confidence in their approach, confidence in the strategy. And then the last thing is consistency in not just gains, but consistency in profits and losses. It's interesting when you go look at how most people end up blowing up their accounts. It's either A, they don't have a strategy that works. So their equity curve just kind of goes like this straight down. Or B, they have a strategy that works, but they're not consistent. So it's going and going and going. And then all of a sudden it takes a nosedive and they have a big blow up day or a blow up week. And then they start trying to crawl their way back out of the hole and all of a sudden they take a nosedive. So you have to, as a trader, have consistency in what you're doing and consistency in the profits and the losses. You cannot afford to have blow up days. It's okay to have a down day or a down week or a down month or even a down year, depending on the type of trader that you are. But it's not okay to erase a week or two in a single day or 3 or 4 weeks in a single week or a month or several months in a single month of bad trading. Okay, so you have to have that consistency in your gains and losses. Now, with that being said, what are you going to learn today? Because I always try to teach people something. Whenever you're taking time out of your day to spend with me, I want to make sure it's worth your time. So I try to teach you something. So we're going to be discussing the 3 components of trading, 3 components of what we call technical analysis and how they work. We're going to talk about understanding the fundamentals of objective value. We're going to talk about how to read the value charts indicator on the MetaStock platform. And we're going to talk about intro to value range trading. All right. Now, today we're going to cover all this. And for those of you that go, you know what, this is great, I want to learn more, good deal. I'll show you how you can take the next step and how you can get the MetaStock bundle and get this add-on. For those of you say, you know what, not really for me, no problem whatsoever. All righty. So with that being said, keep in mind the law of diminishing intent. Now, this applies to more than just trading, but what the law of diminishing intent means is we always start off with the best of intentions, whether that be this is going to be the year that I follow my rules and stick to my trading plan and do everything right. Or we say, this is going to be the week I start my diet. But the longer we put off actually making a change and taking action, the longer we put off taking that first step, the lower the probabilities of us following through and the less energy we're going to have to actually follow through. So keep that in mind. If you decide, okay, this is something I want to do, it's time to take that move, make that next step, then go ahead and dive in and do it. Don't keep putting it off. All right, so let's talk about the 3 components of technical analysis, what they are and how they work. But before we do that, I want to kind of go into a little bit of information about how most traders feel when they go to place a trade and what this stems from. So think back to your most recent trades, all right? What is the first feeling that you get when you're about to place a trade? Is it anxiety? Are you anxious about it? Are you nervous? Is it uncertainty? Is it hesitation? Maybe it's you have the fear of loss or pain or disappointment, disappointing not just yourself, but others. And one of the biggest things that causes traders to do poorly is emotions in trading. And one of the biggest reasons traders have these emotions start kicking in and flaring up when they're about to place trades is because they've never experienced success. So one of the things I always tell people to do when they're looking to, I'm going to go learn how to trade the markets, or I'm going to start doing this new strategy. I always encourage people to start off trading simulated. All right. And this will help in a couple of ways, but it's going to help build confidence in your strategy, which will help you get rid of a lot of the emotions, control a lot of the emotions. But it's also going to help you to get the memory down. Or I know muscle memory is not technically a thing, but your brain will start thinking about things the same way. Because you go, okay, I know I do X and I get Y result. I do X and I get Y result. And you do that several hundred times, or you do it for 6-7 months of sim trading profitably. Then when you go live, it's just a matter of rinsing and repeating, doing the same thing. Okay, now with that being said, there's certain limitations to simulated trading. Obviously, things like slippage are not necessarily as robust in sim as they are in live. But again, I always encourage people, start off simulated and get the basics down, because you can't make money simulated. You're not going to make money live. And the other thing I always tell people is, look, most traders overestimate what they're going to be able to do in a year, but underestimate what they're going to be able to do in 5 to 10 years. Okay, so don't be in a hurry. That's another big account killer, is everybody gets in a hurry. So let's talk about the 3 components of technical analysis. There's 3 big things we want to look at before we place a trade. Okay, the very first thing is price. And we analyze price based on price charts. You can use candlestick charts, line charts, open, high, low, close, etc. But we look at price and we want to know how the market itself is moving. That's one of the cornerstone blocks, one of the big 3. The second thing we look at is momentum. What's the strength of the market? How much momentum is behind each move that we're seeing the market have? Is there a lot of strength behind a move, or a little bit of strength? Are we ripping, or is it just slowly moving our direction? And then the last thing is value. And when I say value, I mean objective value, not subjective value, not your opinion of whether or not a market's extended one way or the other, or in an attractive value zone. I mean, objective value, and the way we do that is we use tools like the value charts indicator, which I'm going to be talking about today. Now, let me tell you why this is so important. We have a fund that we worked with in the past, and they had a system they were trading, and on average, that system was losing $30,000 a month. Okay, that system averaged a $30,000 a month loss. Well, one of the things we did, we went in and we said, okay, all we're going to do is we are going to add a filter, and the filter we're going to add is value. So we're going to make sure we're buying from attractive value zones and selling from attractive value zones, as opposed to getting in at extremes and the wrong side of an extreme. And that same strategy, by adding this third component of technical analysis, went from losing $30,000 a month to averaging a $30,000 a month profit. Okay, so it had a 180-degree turn that fast just by adding that third component, which is what most people are missing. So let's talk about the value charts indicator, what it is, how it works, and how we read it. All righty. Stock market is ripping here. So the value charts indicator it's really simple to look at. It plots price in one of 5 color-coded value zones. All right. We have fair value, which is going to be plotted as center green. Then above that and below that, we have moderately over and moderately undervalued. Okay, moderately over and moderately undervalued. That's going to be upper and lower yellow zone. The next thing we have is significantly over and undervalued. That's going to be plotted as upper and lower red. So it's going to be significantly, when a market gets very extended one way or the other. Okay, so when we look at that, it looks something like this. All right. So you can see all 5 of your value of your zones here. And I want you to think of this kind of like a bell curve. Okay, excuse my sloppy drawing there. But the way that it works is, as you get into the extremes, the probabilities of trading up here are much, much lower. And as you get down into the middle, that's where the market typically is going to be trading inside of. Now, we went and we had this back tested by PhD statisticians, and I'll get into that here in just a minute. But over 30 plus years of data, the markets typically trade significantly over and undervalued, the upper and lower red zones, about 2% of the time. They trade in moderately over and undervalued about 14% of the time. And they trade in fair value, 14%. They trade in fair value about 68% of the time. Okay, and this is just roughly, and a little bit more precise than that, but roughly 68% of the time fair value, 14% moderately over and undervalued, and 2% significantly over and undervalued. Now, again, we went back and we had this verified by 3 different independent PhD statisticians, Dr. Abraham Weiner from University of Pennsylvania, Wharton School of Business, Dr. Eric Laber, University of Michigan, and Dr. Sheila Nair, University of California, UCLA. And all 3 of them were in agreement that the value charts indicator was highly effective in determining valuation in dramatically changing market environments. And it does this by shifting its bias based on what we call dynamic volatility units. So it adjusts value zones and adjusts to current market volatility to determine whether or not a market has gotten significantly extended one way or the other. Okay. So with that being said, let's dive into what this looks like on Metastock and how we read this. So when we look at it, it's going to be plotted just like this. You're going to have your upper red price bars, lower red price bars. So again, your 4 zones here, or 5 zones: fair value, and then overvalued, undervalued, significantly undervalued, and significantly overvalued. And they correspond to the candle directly above them. All right. Making sense so far? Everybody following along? Good deal. So one of the things that we look to do is we don't want to just blindly buy and sell value. And that's a mistake a lot of traders make, is they just think, once they get value charts, they go, oh, well, this tells me statistically it's supposed to move one way or the other, so I'm just going to buy and sell as soon as it hits significantly over undervalued. And that's not what we want to do, except for in specific market environments, which we'll get into in just a minute. But when the market is trending, we can apply a value-based filter, so we have a higher probability of getting in and having the market turn our direction quickly. So what do I mean by that? Well, we look for something like this. This is Amazon, for example. And you can see Amazon has obviously been in an uptrend, right? So what are we looking to do? Every time we dip down undervalued, we're looking to buy into the uptrend. So what we're doing is we're timing our entries into the trend with a very high probability of once we get in, it turns and starts moving back our direction. Now, one thing you'll notice is when you're in an uptrending market, you see the market overvalued a lot more often. And that is a good thing. There's nothing wrong with that. In an uptrending market, we expect to see overvalued prices. In a downtrending market, we expect and want to see undervalued prices. That means there's strength to that trend. If it just is barely moving in fair value, that means the market really doesn't have a ton of strength to it. Making sense? So again, when we're in a trending environment, we'll apply a bias and we'll say, okay, we're only looking to buy because we're in an uptrending market. So trend is our friend. And we will buy every time we dip undervalued. If we're in a downtrending environment, we'll look to sell every time we bounce overvalued. Now, remember, I told you we're going to talk about value range trading. So let's dive in here with value range trading and how this works and what it is. All right. So value range trading is a great strategy to implement in the correct market environment. Okay. That correct market environment is a sideways or compressing market, not when a market is trending. So essentially what we're doing is we're looking to profit from market fluctuations between over and undervalued, because when the market's moving sideways, we just want to time our entries near the upper end of an extreme and then ride it back down to the lower end, then ride it back up to the upper end, right? So we're going to do what we call value range trading. We're just going to trade between the value ranges, overvalued and undervalued. Now, we don't want to just blindly buy and sell moderately over and undervalued. We want to make sure there's a high probability of it pulling back and going our direction. So we want to look for significantly over and undervalued prices. All right. Now, again, you want to be careful attempting this strategy during the incorrect market environment. We must have a market trading inside of a range moving sideways or in a consolidation based on price action. So remember, we look at price, momentum, and value. So we want to see price action doing something like this, where we are moving sideways, staying inside of compression, and then we're looking to trade once we hit value extremes. Now, if the market is trending, value range trading is not going to work as nearly as well. We want to implement a directional bias like I was just talking about, which is buying undervalued in an uptrend and selling overvalued in a downtrend. All right. Makes sense? So this is what it would look like. This is Tesla. All right. And we're looking at value charts down at the bottom. This is the NQ momentum indicator here in a minute. NQ momentum here in the middle, and I'll talk about that here in a minute. But what we're looking to do is every time we get significantly overvalued, we're looking to initiate short positions. Once we get undervalued, we're looking to buy. Undervalued, we're looking to buy. Overvalued, we're looking to sell. Okay, and all we're doing is riding out the different zones. So we'll go from overvalued to moderately undervalued, undervalued to moderately overvalued. And every time we hit an extreme, we'll look to place our trade. Okay. And again, all our goal is we're not looking to catch huge moves because, again, the market's compressing. It's not trending. So you don't get huge moves in compression. All we're looking to do is take quick scalps between the different value ranges. Now, one of the easiest ways to determine whether or not a market's compressing or trending, look at your pivot highs and lows. If we are trading inside of the range of the previous pivot high and low, then you're in compression. If we see the market putting in higher high and higher low pivots, then we're in an uptrend and we'll want to be only buying undervalued. If we see the market putting in lower high and lower low pivots, we're in a downtrend and we want to be selling overvalued. Okay. So when we look at this, for example, this is Alphabet. We have our pivot high up here and our pivot low down here. we're in compression. So we're looking to buy significantly undervalued, sell, buy, sell. Okay. While we're in compression there, and the market continues to stay in compression, we hit significantly undervalued right down here. We get significantly overvalued right there at the very top of that price bar. Significantly undervalued right down here. And then what happens? We start going higher high and higher low pivots, right? So now what are we looking to do? Now that we've got higher high and higher low pivots, we're buying undervalued only. Buying undervalued only. That way, we stay on the right side of the trend until what happens up here. So we'd have entry, entry, and entry. And then what happens? The trend changes, right? We go lower highs and lower lows. So now we're looking to sell overvalued bounces only. Overvalued, overvalued, overvalued here, and overvalued there as the market continues to trend down. So again, once we use that price action to determine bias, then we start entering based on the trend using value charts to determine that we're getting in at an attractive value zone, an attractive value level. Now, one thing that's great about Metastock, and this is not on any other platform, this is unique to Metastock, is we've set up the value charts indicator to have what we call expert commentary on current market developments. Now you can turn this on or off if you want it or don't want it on your Metastock platform, but you can use this tool when analyzing the current market to help identify potential setups and market bias. So if you're not sure, the indicator will actually do it for you. You can see here, this is how it looks. And it tells you current price bar information. It tells you the current value charts analysis and considerations to take. Okay, so it's a VC buy opportunity. Conditions indicate this market's momentum is gaining at the same time its relative valuation is still low, representing a value buy that has potential energy to move higher and room to run. Okay, so we can start implementing trades based on expert commentary if you're not familiar enough with the tools to use them yourself and do your own analysis. It's like cheat codes, basically. So let's talk about trading momentum and value, because like I had mentioned a minute ago, I'll explain to you what the MQ momentum indicator is and how it works. So momentum and value here. One of the other things you're also going to get access to with the value charts indicator suite is the MQ momentum indicator, which is an oscillator. It's a momentum oscillator, and it's used in determining market strength or how much power or force is behind a move. One way of using it is to identify bullish and bearish divergences. So all a divergence is when momentum and price action diverge. They're no longer in agreement. Normally, if we see the market trending higher like this, we want to see momentum trending higher like that. But occasionally what will happen is you'll see the market trending higher like this, and the momentum will have been going higher with it. And then all of a sudden momentum will be down like that. So we'll have strengthening market, strengthening price, but weakening momentum. And that oftentimes will signal when a market's about to go into compression or even reverse. Okay. So when we're looking at the MQ momentum, this is what it looks like, and this is how we read it. There's a few different parts to it. There's the indicator lines here. All right, fast and slow line, and they kind of tell us the overall bias, the overall trend of the market. And just like we look at price action, we say higher high and higher low pivots on price action is an uptrend. We look at the MQ momentum and do the same thing. We say lower high and lower low pivots is a downtrend, higher high and higher low pivots is an uptrend. And that's how we can determine the overall momentum trend. Now, ideally, momentum is going to agree with price, and that means the trend should continue. Knock on wood. Okay. When momentum and price no longer agree, that's when we start getting a divergence. Now, the second part that we look at are the histograms here. We have bullish histograms, up histograms, and bearish histograms, down histograms. And what those are telling us is kind of the strength of the force behind a move. So we could say, for example, the down move that took place over here had a lot more strength than the down move that took place right here. Just like this up move had more strength than this up move. Okay, so we can determine whether or not the swings, the momentum behind each swing as the market moves, is strengthening or weakening. So let's talk about momentum divergences. And remember, a divergence occurs when momentum and price are no longer in agreement. So this is Apple. And as we come down here, we look at the price, and the price is going lower highs, lower lows, trending down, right? And momentum is in agreement. We're going lower highs, lower lows. But then what happens? On this most recent dip, price goes down and hits a new low. But our momentum indicator line is stronger and our histograms are stronger. And you're looking at one set of histograms here to another set of histograms here. So we have strengthening histograms, strengthening momentum, weakening price. What's that tell us? That's a bullish divergence. And it says, careful. It has potential to go into it. We expect it at least to go into consolidation. We do not expect the down move to continue to run. And if we can break through the pivot high up here, we're looking for a bigger retracement. So in this case, we end up changing trend and climbing right back up, and we have a bigger retracement back to the upside. All right. So this is how we're starting to combine. Remember the three components of technical analysis? This is how we start to combine price, momentum, and value and get that idea of, okay, this is how we start picking trades up when we start looking at all three components. All right. Here's another example. This is Google. And we look at this and we start looking for divergences. You can see price is climbing on the way up here, remember? And then what happens? Look at what happens to our momentum. Momentum starts to really die off here, and our downswings start picking up more strength. Okay, and our upswings start losing strength. So what happens? Momentum starts trending down. Then what happens here? Once again, momentum starts saying, hey, there's not a lot of bias, and what's the market doing? Just chopping sideways. And we can use momentum combined with value to then determine when we do or do not want to be establishing these trend following trades. So for example, we would not want to be buying an undervalued dip over here or buying an undervalued dip here because momentum has weakened. But when we're trading on the way up, we're good for buying the undervalued dip here and buying the undervalued dip there. This one, not so much. All right, now if this sounds complicated, it takes some getting used to. Again, everybody thinks they're going to pick it up right away. It takes time and practice. All right, but another thing that we've done, another quote unquote cheat code here, is we've added the value charts tools on Metastock. Again, this is unique to Metastock. We've set them up so that they can call out potential buy and sell signals that are hitting extended, when the market's hitting an extended level according to value charts, and it has opposing momentum. So when the momentum and the value are going, hey, this is not quite right. And that's what looks like right here. So this is IBM. You can see like VC sell, it's a sell signal, VC buy, VC buy. Then we have bullish pressure, bearish pressure, bearish pressure, bullish pressure, buy signal, bearish pressure. Okay, so it'll start calling out exactly where these potential momentum and value opportunities are showing up in the market and pointing it out for you and showing you, hey, here's the opportunity, and starting to call it out on the chart for you. So this combined with the expert commentary gives you a really good idea of which way a market should be heading. Now, with that being said, the other thing you're probably wondering is, Thomas, what are these dots? What are all the dots above and below? Those are when a market's hitting over and undervalued. So the bigger the dot is, the further into over or undervalued it is. If it's a yellow dot, that relates to moderately over or undervalued. If it's a red dot, significantly over or undervalued. Really small red dot means barely poked into significantly undervalued or overvalued. A big red dot means went way up into significantly over undervalued. So right here, big red dot, right there, big red dot, you see bounces right back up immediately because the market got too extended. Same thing there, in here, in here. All right. Now the other thing is you have the ribbon down at the bottom, and this gives you a bias. This helps you with determining bias based on value. So you can see through this whole section here, it's saying we have bearish bias. And then what do we start seeing? Neutral bullish pressure coming in. So we're bearish, neutral bullish pressure coming in, market goes into consolidation again. We go bearish again, neutral bullish starts going back into consolidation. So you can also use the ribbon to determine the direction that we should be trading. Here's another example. This is Tesla. Once more, just showing how momentum value charts and momentum indicators work together. And you can see the VC buy and sell signals showing up here. VC sell, VC sell, VC buy, working out really well. Every single one of those are making money. Then you can see neutral bullish pressure coming in. Market starts to climb, bullish, market starts to climb. Now, I'm not sitting here telling you that every single time we get bullish pressure or bearish pressure or a VC buy or VC sell signal, every single time that occurs, the market is going to rip your direction. It does not work that way. Again, markets do not trade that way. However, we can say that over time, we statistically have the higher probability of the markets moving our direction. So you got to use your own analysis and you want to use your own knowledge on how to trade alongside this. But when you have something, let's say a bullish signal that you're looking at, plus we start seeing bullish pressure coming in, then we say, all right, this is a stronger buy signal than it otherwise would have been. Make sense? So I know I'm finishing up here a little bit early, but my next question for you then is, do you see how and are you ready to maximize your profitability, increase your consistency, and grow your confidence? And if you're wondering what those three things came from, remember, those are the three big things that help separate consistently profitable traders from the 90% that lose money. Okay, and can you see how the value charts tools end up helping you with that and achieving those goals? Let me show you some success stories. These are all traders that I've worked with one-on-one and how they've done. These are their equity curves. So this is Randy's equity curve. He trades value spreads and value retracements. He's done really, really well. You can see it just following along very nicely. This is, remember I told you there was one of my proudest things to say is there's somebody I worked with that went from consistently losing money to running their own fund. Well, this is Lori. This is her equity curve, and she runs a bond fund now. And her equity curve looks better than mine. It's one of the best looking equity curves I've ever seen. This is Frederick's equity curve. He trades spreads, future spreads, again, using value, momentum, everything else. This is Tom. Tom Trem also doing similar, trading spreads, future spreads, doing really, really well. Another thing I always like to show, this is a little older, it's from 2015, but it's Bill. And Bill sent me his broker statement, sent me his equity curve. And the reason I like to show this is because everybody says, well, Thomas, how much money does it take to trade? How much money do you have to trade with? Well, it's unique to each person. And like I said, you always want to trade with risk capital. But Bill started off with a $1,772 account. And in about a month's time, if I remember correctly, month and a half, he turned it into $12,642 using value, momentum, and price action. Okay. And this is one of my favorite people to talk about. This is Dave Glissmeyer. This is his equity curve, again, a great looking equity curve. And he realized his goal. His goal was always to become a professional trader. Okay. And before he passed away a little while ago, he realized that goal of trading for a living. He was paying his bills off of the returns he was making from trading. And he went from taking 50 plus trades a day to taking 3 or 4 trades a day. Okay. Went way down in number of trades, but way up in quality. And his profitability went sky high. So like I said before, for those of you that say, this looks really interesting, I want to learn more, I want to take the next step, this is how you do it. All you got to do is go to metastock.com/value charts A. You can get the value charts add-on for $9.97. And as a bonus, one of the things we're going to do is give you an entire workshop on value trading, how to trade using value. So we're going to give you the value trading bootcamp workshop. It's a couple hours long. It teaches you the ins and outs of how to trade value. Again, all you got to do is go to metastock.com/value charts A. All right. Will the add-on be updated if the patented indicators need to change due to market conditions? Yes, but the indicators have a type of self-learning in there that makes them adjust to changing market conditions. That's why they're patented and why they work so well. Now, there's a couple things that always come up here, and these are, but what if? So what if it's bad time and I don't have the money right now? Well, I'll tell you this, it's never going to be the right time, and it's never is the right time. You got to push yourself past your own rationalizations about why you can't do something and make the decision on why you can. The other thing is, I'm not sure this is going to work for me. Well, you're 100% right. If you're not coachable, if you're not willing to make a change, if you're not willing to stop doing what you're doing, which isn't working, and start doing stuff that does work, then it's never going to work for you. But we've helped thousands of traders from around the world, and the ones that commit and put in the effort, it does work for them. And the last thing is, I need to talk to my spouse. Well, this can be honestly one of the number one excuses I use to justify not doing things I don't want to do. And many times what I find is it's really the underlying fear of, what if I dive in? What if I actually give it my all, give it my best effort, and I fail? And it's that fear of failure that holds people back from making a change. So don't let that be the reason that you don't dive in, that you don't take that next step. Now, again, metastock.com/value charts A is where you can go to get the value charts add-on. If you need help getting it all set up and everything, they have people standing by. You can call them at 800-882-3040. Okay. So yeah, the add-on, Lee was asking, will the add-on be updated if the patented indicators need to change due to market conditions? Again, there's built-in adjustments, so it automatically adjusts to current market conditions. All right.
Okay.
Any other questions?
Yeah, there's some questions coming in from YouTube.
Hopefully you learned something. Again, Jeff, I apologize. I know I'm finishing up here a little bit early.
Hey, no problem. We do have a question that came in from YouTube, and there's a few things I want to show with the software too, if you don't mind.
Sure.
But earlier, you did mention the market is ripping. And the question that we had that came off of YouTube was, what would you do to find out why the market is ripping?
Pay attention to your news. But what happened is we broke through. We had 32 3/4 resistance in the ES, the S&P, or 32 1/4 if I remember correctly. And the S&P just broke through that resistance right at the market open. That's why it started. That's why I said it was ripping. It jumped from 29.30 up to 29.40, just about.
Sure.
So yeah, it's breaking through resistance.
Lee has a question that I'm going to kind of take a little bit of a stab at here as well, because it has a little bit to do with kind of the software. So let me turn back on my screen. I actually do have Metastock loaded right here, and the question has to do with explorations. I've seen the other presentations and wonder if there are explorations that only return the VC buy or VC sell. That's a really, really good question, and I'm going to go ahead and close this for now and talk about the actual explorations that are in the program. So with the value charts, you can run scans or explorations against a market that'll show you everything that's significantly or extremely overvalued or undervalued, and those are these explorations here. If you just want to find where the VC buys and VC sells are, that's now available. It's actually the first revision we added to this. And to run it, you just say, I want to find all the charts that have a buy signal. Okay, I actually ran it against all of my optionable stocks earlier, and out of the 4,325 that were optionable, you'll see there's in the report here, out of the VC buys, there's only maybe 5 that were returned. So what a powerful way to actually go in and not look at 4,300 stocks. This gives me some that I can look at right now that just have that VC buy signal. So it's a good question, Lee. Thanks for asking it. And yeah, absolutely, you can go in and run an exploration. This is one of the ones that I actually personally asked the programmer to add once we got everything released. I'm like, we really need an exploration to find the buy and sells because it's very, very valuable. It's one of the things I love about Metastock is the ability to ignore 4,320 stocks and focus on 5 that have results or opportunities there. It is a full-featured add-on, which means it does come with the expert commentary. As Tom was showing a little bit earlier, you're going to have all of the analysis that shows up on the chart. In addition to that, you're going to have the commentary over here. So you'll notice right before we had this pretty good run up, you had one of those VC buy conditions that we were scanning for. And if I just put my commentary, this is the commentary over on the left-hand side. If I just put my commentary on the chart, it's going to say a VC buy opportunity. Conditions indicate market's momentum is gaining. At the same time, the relative valuation is low, represented a value to buy. So it's recommending a VC buy here. This would have been a great time to buy. We don't see a buy condition since then. You did run into some natural bearish pressure, natural bearish pressure, and some natural bearish pressure. But these, you see where this last sell came in, another really good term. The ability to scan for those signals is actually very, very helpful in a marketplace. So it is a full implementation into Metastock, and Tom, you guys did a really good job putting it in to the software. I'm going to go ahead and put up the slides again here. There's a lot of stuff in here that I can kind of go past. This is a product that's actually been really, really well received. What we do here is we actually give you, normally it's $14.95. It's a brand new add-on. We're going to do it at a one-time cost of $9.97. So that's not a price you have to pay over and over again. You pay it one time. We back it with a 30-day money-back guarantee. You're going to get the boot camp along with it. So if you're interested in it, I'd recommend you try it. The risk reward is really there with a money-back guarantee. So it's 800-882-3040 to order. You can visit online at metastock.com/saleschat. And you can also order online if you want to at metastock.com/valuecharts. Give it a go. What do you have to lose? Tom, do you have anything to add there?
No, that's about it, Jeff.
I thought you might have checked out there for a second. Yeah, give it a go. It has been very, very well received. If you have questions, feel free to give us a call. It is a Metastock add-on, so it does require Metastock to run. If you're not familiar with Metastock, Metastock's only been rated #1 for like 25 years in a row. We'll include a trial to Metastock as part of that. You can find your new trading platform at the same time if you're not familiar with Metastock and you haven't seen it before. So again, $9.97 is a special price. You get that boot camp. In addition to that, you're going to get a 30-day money-back guarantee, and if you needed, a free trial to Metastock. So with that being said, I'd recommend you try it. I appreciate your comment tonight. Tom, thank you for your time. And as always, we'll see you at the next one.